Welcome to the Deep Dive. Today, we're getting straight into Hormel Foods Q3 2025 earnings. It's a really interesting story, actually. Strong sales, but while some real pressure on profitability, we'll unpack what that means for them and maybe, the wider food industry picture. So diving right in. Q3, it was kind of a mixed bag for Hormel, wouldn't you say? On one side, you have these impressive organic net sales, $3.03 billion. That's up 6% year over year, which is pretty solid. Organic volume also up 4%. It wasn't just one area carrying the load, right? It was broad-based. Retail, food service, international, all showing growth. Retail volume and sales up 5%. Food service organic volume up 2%, but sales up a strong 7%. And international, volume up 8%, sales up 6%. So, demand looks healthy. And here's the but, right? Here's where it gets tricky. Despite all that momentum on the top line, the gross profit was described as relatively flat year over year. And even more telling, the segment profits actually went down. Retail down 4%, food service dipped 1%, and international fell, 13%? That's quite a drop. All this rolls up to an adjusted EPS of $0.35.
Which, well, it missed the street's expectations. So, yeah, great revenue coming in the door, but less of it seems to be sticking. What's going on there? What's that core disconnect?
Yeah, you've nailed the central issue right there. It is that disconnect. You see this really strong top-line performance, that 6% organic sales growth, but it was pretty much canceled out, offset by higher-than-expected input costs. It really paints a picture of, continued margin pressure. That's the key phrase. Basically, the cost of their ingredients, their operations, it just rose faster than they could make up for with sales gains. So that revenue boost didn't flow down to the bottom line like you'd hope. It's a classic squeeze, really. Especially tough in the food business, where margins can be thin anyway. Small shifts in commodities, they can have a really big impact. It forces this constant balancing act.
Right, the balancing act between costs and pricing, especially when consumers are watching prices.
Yeah.
So, okay, you see the margin shrinking. What's the specific driver? The announcement pointed to a steep run-up in commodity markets. Sounds like it wasn't just a little bump. What kind of numbers are we talking about?
Yeah. Exactly. It wasn't gradual. And when you look at the specifics, it's pretty stark. Hormel mentioned pork bellies, super important for stuff like bacon, were up roughly 30% year over year in Q3.
Wow.
Yeah. And the pork cutout, kind of the wholesale value of the whole hog, that was up 10%. Pork trim used in sausages, lunch meats, that was up 20%. And it wasn't just pork. Overall raw material cost inflation, about 400 basis points in Q3 alone.
400 basis points. So a 4% jump in core ingredient costs in just 3 months.
You got it. Significant. Yeah. And then you add beef, which they said was a persistent inflationary headwind. So this really sudden, dramatic surge in their key ingredients, that was definitely a major hit to their profitability. And, this brings up a key point. Why does it hit so hard so fast? It comes down to this inherent delay, a delay between when they start paying more for materials and when their own price increases actually take effect and improve profits. The higher costs at their books almost right away. They pay more now. But raising prices on the shelf or for restaurants, that takes time. There are contracts, competition, how shoppers might react.
That timing lag.
Exactly. During that lag, costs are up, prices aren't fully caught up yet, and boom, margins get squeezed hard. It's a test of agility, really.
That makes total sense, like bailing water while the leak gets bigger.
Mm-hmm.
I wonder, though, does a company Hormel's size have more cushion? Or does their scale make them even more exposed when costs jump like this because they buy so much?
That's a great point. It's kind of a double-edged sword, isn't it? On one hand, yeah, their scale gives them buying power, lets them use hedging strategies maybe smaller guys can't. They can negotiate. But precisely because they operate on such a massive scale, when you get a widespread sudden surge like this one, it affects a huge volume of their inputs. Pork bellies jump 30%. That's a massive dollar impact for a company their size.
Right.
So while they have tools to manage it, they can't totally escape those big market swings. The squeeze feels really intense across the whole portfolio.
Okay, so faced with these rising costs, what are they doing? How's Hormel fighting back? What are the main strategies?
Well, the primary tool is definitely targeted pricing actions, taking prices up where they can. But it's tricky, right? Especially in retail, it takes longer to implement price changes there compared to, say, food service.
Yeah, menus can change faster than grocery store tags sometimes.
Exactly. And they have to balance those rising costs against how shoppers will react. You don't want to lose customers. Brand health matters. Management said they expect the real benefits from these pricing actions to start showing up late in Q4, but mostly into fiscal 2026.
So that lag effect again. It takes time.
Significant time, yeah. The full impact won't be immediate.
Okay, pricing is one lever. But I know they also have this big internal project, the Transform and Modernize Initiative, or T&M. What's that all about? Is it just about cutting expenses?
No, it's actually much more holistic than just cost cutting. I mean, efficiency is part of it, sure. But T&M is really about building new capabilities, modernizing how they do things, optimizing their whole manufacturing network, making it more resilient, more agile for the long run.
So things like automation, supply chain improvements.
Could be all of that. Data analytics, streamlining logistics, maybe even rethinking which products they make where. And it seems to be working. They said it delivered in line with quarterly expectations. Got benefits from around 90 projects just in Q3. Management actually expects to finish near the high end of their goal for the year. That's $100 to $150 million in bottom line benefits for fiscal 2025.
That's substantial.
It is, and it includes big moves, like partially closing a facility, reallocating production. It's about future-proofing, not just quick fixes.
Makes sense. Now, on the financial side, they also mentioned an intentional inventory build in Q3. Sounds strategic, but how did that play out with these high commodity costs? Did it affect their cash flow?
It was definitely strategic, yeah. But timing-wise, doing it in this high-cost environment had consequences. They built inventory mainly for things like back-to-school products. The Skippy peanut butter was noted.
Getting ready for lunch boxes?
Exactly. And also to support center store fill rates. Basically making sure their everyday stuff is consistently on the main grocery shelves. That's crucial for meeting demand, especially seasonal peaks. But doing that build when raw materials are expensive, it directly hit their cash flow from operations. It was $150 million in Q3. Higher than Q2, but lower than last year.
Because they're holding more expensive inventory.
Right. Ties up cash, it's that trade-off. Ensure availability versus managing working capital when costs are high.
Got it. But despite those pressures, their overall financial footing seems pretty solid, doesn't it? They paid out $159 million in dividends. That's their 388th consecutive quarterly payment. Incredible streak. And their net debt leverage ratio is apparently well within the 1.5 by 2x target. What does that ratio tell us?
Yeah, that ratio is a really good sign of their financial health. Being well within that target means their debt level is quite manageable compared to their earnings. It speaks volumes about their stability even with these commodity headwinds, shows they have a strong balance sheet, good underlying cash generation.
So they have flexibility.
Exactly. Flexibility to invest in things like T&M or absorb these temporary margin hits without, putting the company or that amazing dividend streak at risk. It's a sign of good financial management.
That strong foundation is definitely key. And despite the overall profit picture being tough, there were some real bright spots. Specific brands seemed to perform really well, showing some strategic strength.
Absolutely. And looking at those is interesting. Jennie-O ground turkey, for instance, saw a 13% increase in volume, actually grew faster than the category, gained market share.
Even with higher prices.
Apparently, yeah. Suggests strong brand loyalty. Maybe they navigated the pricing well. Shows it can be done. Then you have Planters, back to year-over-year growth in distribution, household penetration, dollar sales, helped by innovation, things like nut duos, flavored cashews. New stuff can still drive demand. And in food service, Hormel Premium Pepperoni delivered 20% year-over-year volume growth. 20%.
Wow, that's huge in food service.
Way ahead of the industry average. Points to strong partnerships, maybe dominance in a popular category. Internationally, growth came mainly from their business inside China, retail, and food service there. Plus, some meat snacking innovation, Skippy cones getting wider distribution. Even though Brazil was tough competitively, these other areas show they can execute well globally. It shows how strong brands can maintain momentum even when consumers are being cautious.
Okay, so these brand wins are great for the top line, keeping sales moving. But are they enough to really counter those big systemic margin pressures? Or is it more like they're keeping things from being even worse?
That's the million-dollar question, isn't it? These successes are definitely crucial. They maintain market presence, drive that revenue growth we saw. But to fully offset something like a 4% jump in raw material costs across the whole business, that's a tall order. You'd need much stronger pricing power everywhere, or just dramatic cost cuts. So yeah, I'd say these bright spots are vital counterweights. They keep the ship moving forward, show brand resilience, they stop things sliding further. But they probably can't alone reverse the whole margin squeeze. That's where those bigger strategic things like T&M have to do the heavy lifting on the cost structure side.
Right. So bringing it all together, let's look ahead. What's the outlook for Q4? And how are they thinking about 2026 now?
Okay, so for Q4, they expect sales growth to continue, so still positive on the top line. However, the adjusted EPS guidance is cautious, $0.38 to $0.40. That reflects what they called a prudent outlook, given these ongoing industry dynamics, especially the high commodity costs. The basic message is profit recovery is expected to lag into next year.
So the squeeze continues for now.
Pretty much. Management is signaling those headwinds aren't disappearing overnight.
Makes sense to be cautious.
Yeah.
And longer term. They had set some specific goals for fiscal 2026 previously. Is that plan still on track, or has this environment forced a rethink? That raises an important question, doesn't it?
It really does, and they were quite direct about it. They explicitly said the growth goals we previously set for 2026 were based on certain assumptions that have not been realized. Meaning they'd hoped for more stable input costs, stronger consumer spending, better earnings growth in 2025, and things didn't quite pan out that way. It's a pretty honest assessment that the landscape changed on them.
So what's the plan now?
Well, they'll give full 2026 guidance later on the Q4 call, but for now they're pointing back to their standard long-term growth algorithm. That's aiming for like 2-3% net sales growth and 5-7% operating income growth. They see that as a better metric for now.
So dialing back maybe from more ambitious targets to something more foundational, more sustainable given the current reality?
That's how it sounds. A recalibration based on the conditions they're actually facing.
And it sounds like leadership gets the pressure. Interim CEO Jeff Ettinger said the mission is clear, build on the sales momentum, but urgently return to bottom-line growth. What does that urgency signal to you?
Yeah, urgently is a strong word there. It suggests they're not just waiting for costs to normalize. It probably means accelerating those strategic initiatives like T&M. Being maybe more aggressive on pricing where possible, definitely on optimizing costs. It signals a real focus on execution, maybe faster decisions, constantly looking for efficiencies. It tells shareholders, look, we know we need to turn these strong sales into actual profit growth, and we're focused on doing that sooner rather than later.
So wrapping this deep dive up, what we've really seen is a major company, Hormel, doing well on the sales front, leveraging its brands, but getting hit hard by unexpected steep commodity inflation. They're selling stuff, but it's costing them more to make it, squeezing profits. It's a fascinating case study.
It really highlights that constant tension in the food industry, doesn't it? The need to adapt quickly pricing, operations, while keeping consumers happy and protecting the brand long term. And it shows why initiatives like their T&M program are so critical, not just for fixing today's problem, but for building a more resilient, agile business for the future. In a world with volatile commodities and supply chains, these kinds of investments are about staying competitive long term.
And for you, the listener, this really gives a window into how big economic shocks can affect even established players. It shows top-line growth isn't the whole story. So what does this mean for you? Maybe think about how quickly companies can adapt when costs surge like this. What does that tell you about business resilience today? Which parts of a business are most vulnerable to these shocks? Which are more insulated? And, how much power do strong brands really have when raw material costs are soaring and maybe consumers are feeling the pinch? Keep those questions in mind.